Happy Friday to you on Friday, the 23rd of January 2026, ahead of a long weekend, both in Australia with Australian Anniversary Day and in Auckland with Auckland Anniversary Day. And happy it's been for the markets as well. Gold rallied up another 2% to close at 49.40 and it quickly approaching the magic 5,000 level. It's up 14% year to date and outdone by silver, which again has a strong run, up 3.5% at $96, and again fast closing into the $100 mark. The S&P 500 gained around 0.6% to close at 69.13, up above that 6,900 magic level again, which is great news for the market given the sell-off earlier in the week. The fear gauge also is a great indicator of what may happen in the future, and the fear gauge again fell below 16, the VIX, and that is good for the market. In terms of the ASX, it outperformed the US up 0.75, whereas the Hang Seng fell rose by 0.2, so underperformed the US markets. The winners in the US today were Arista Networks up 8.7% on a very strong upgrade, and one of the stocks we mentioned yesterday in the communication services sector was up 5.6% today. Also, that whole communications services sector, which we talked about yesterday, was the best performer today, up about 1.4%. The losers were after hours, Intel, and also before the market, reporting of GE Aerospace meant that both stocks fell around 6.5% in the S&P 500. GE Aerospace being the loser during the session, and Intel being the loser after the market, given its result. So we'll focus a little bit on those two stocks towards the end today. But before that, I'd really like to focus on a particular word that's been bandied around a lot since particularly October, November last year, and that is the word rotation. Rotation away from the mega cap stocks into the broader market, away from the top 7 into the other 493 stock components in the S&P 500. And one of the indicators of this is the industrial sector, and it is definitely a big beneficiary of this rotation away into into this broad market, and is a very good indicator of market breadth. So one of the indicators, we look at the S&P 500, we look at the VIX, we look at other indicators, but breadth is one of the key indicators of a bull market. And so if breadth increases, then that's great for the market. And the industrial sector is one of the early to mid-cycle winners when breadth improves, and that's definitely what is occurring at the moment. So what's happening? The industrials sector is breaking its long-term underperformance in the S&P 500 at the moment, and it's supported by very strong infrastructure spending. Think of the likes of Caterpillar, one of the best performers in the Dow last year, and therefore, one of the beneficiaries, particularly of the data center expansion. There's also the whole premise under Trump of Buy American made. We want things to be moved onshore, and this reshoring and onshoring capital expenditures, the industrial sector is a big beneficiary of that. Also think of in the sector, subsectors, you've got aerospace and defense, and there's huge demand for defense stocks. Think of the likes of GE Aerospace, which we mentioned, and also Lockheed Martin. The other sector or subsector is automation and productivity, and investments in this sector could include stocks like ABB and Rockwell Automation in the automation space. So why should you care about this? Well, it's really a reward for the cyclicals. It's a move into this area. The industrials offer earnings visibility, and often they're not as whippy in terms of price and less risk around valuations going forward. And they really are leveraged to real economic activity. Historically, when rates fall, as we have seen recently, growth is okay, but not overheated. breadth improves, then the industrial sector is one of the biggest beneficiaries of this. So what are the opportunities here? Market breadth expansion is great for the market overall and a good indicator of a long-term bull trend. You've got capex cycle expenditure into machinery, electrical equipment and engineering, driven a lot of it by the AI spending, but also by the onshoring thing that we've mentioned before. The defence and aerospace industry is around structural demand and geopolitical tailwinds, and that again is doing well because of this. The logistics and transport and other subsector supply chain normalization and freight recovery is definitely happening as the industrial sector improves. So in terms of specific investments, if you're not too sure which ones to go into, there is an ETF on each of the sectors in the US. The one on the industrial sector is XLI and gives you broad industrial exposure to the stocks here. And obviously the industries to watch are the aerospace we've mentioned, heavy machinery and capital goods, electrical equipment, and railroads and logistics. So what's likely to happen next, and how could that help the industrial sector? If breadth continues to improve, industrials outperform tech on a relative basis, and leadership becomes more balanced, and then that definitely helps this whole sector. I'd now like to focus on one of these stocks within the industrial sector, and it's definitely been buy the rumor, sell the fact. The market sold off GE Aerospace after its result today, and it was the worst performer in the S&P 500, down 6.5%. But that was because expectations going into the results were very high after a very strong run, and investors should pay attention to this stock because there's a massive engine and services backlog within this industry, and GE Aerospace is one of the biggest beneficiaries of it. They definitely have pricing power in the aftermarket, and one of the biggest stocks in the defence, commercial aviation, and therefore definitely affected by industrial demand here. So what might happen here? Obviously, there's been big gains which need digesting in the short term, but upside on margin expansion and delivery execution long term will benefit this particular stock. The second stock I'd like to look at today is Intel, that reported after the bell. Again, it fell 6.5%, but that was on the back of a rising 12% on Wednesday. Again, buy the rumor, sell the fact. It beat expectations for its result, but again, the guidance was disappointing. So this whole guidance, forward-looking messaging, if it underwhelms, then the market sells off a little bit. So why should you pay attention to Intel? It's definitely one of the biggest beneficiaries in the AI and the semiconductor and the US reshoring messaging that definitely Trump wants in the US. The stock moves on execution, and therefore, hopefully over time, it executes its growth strategy. And if there's clear progress, then the stock will re-rate and continue its rally. So this stock was in the early $20 about 3 months ago. It's up nearly just under $50 at the moment. So it is a very much a turnaround story, and not necessarily a momentum stock, but a turnaround story, and future growth will be interesting for Intel. The last stock I'd like to look at today is one listed on the ASX, Alcoa. The stock has risen very quickly over the last little while on very high aluminium prices and very strong cash flows. Company restructuring and has been a focus as well, and that's been what's happening with this stock. So why should you care about Alcoa? Well, obviously it's an integrated aluminium producer with global exposure. It's leveraged to the construction industry, the AI build out, EVs and industrial demand. It pays good dividends and executes buybacks. So what might happen next? If there's further upside for aluminium prices, Alcoa will be one of the beneficiaries of this. It's definitely a long-term cyclical material play with upside potential, particularly in a tight market like we've had in the ASX recently. So good luck with your trading, enjoy your long weekend, and thanks for joining me.